All right. Well, good afternoon, everyone. My name is Rada Malenovich. I'm the Director of Investor Relations here at Ginkgo. We appreciate everyone for joining us here today for Ginkgo REIT's third quarter update. We'll just give it another 30 seconds and kick it off. Just let everyone join. All right, I'm showing it as 101, so we'll kick it off. So joining me today, I have Bill Green, who's our principal and co-CEO, as well as Eric Stamp, our REIT CFO. Just want to remind everyone that please drop your questions on the chat bot below. We'll make sure to get to them at the end of the presentation. This video is being recorded, so we'll post this to ginkgovest.com under the blog section. Also, we'll post it on our YouTube handle, so you'll be able to replay it on demand. With that, I'll just kick it over to Bill.
Thank you, Rada, and thank you everyone for joining us today. And for those of you who are listening on a recording, thanks for dialing in. But overall, it was really just a solid first half. Pretty much we hit on all sorts of cylinders and really far exceeded what we actually thought we might have. The bottom line, this is portfolio, and everything we're going to discuss today is our portfolio wide. So part of this is joint ventures, part of this is wholly owned assets, and what we're discussing today is our proportional ownership. But our NOI jumped, and it was really a nice jump in both top and bottom line contributors. Revenue, we had strong occupancy and we had improved collections. So where in prior years, we'd had some years with really robust asking rents. We didn't really see as much of that this year. I would say the total trend in asking rents were a little bit more normal, kind of 3 and 4% kind of same store revenue jumps. But what we really saw again is we saw continued strong occupancy with really improved collections. Uh, but the bottom line really came together really well. And op expenses at plus 4% might sound like a big number, but compared to where it's been over the last 3 years, it's really not. It's I think there were two out of the last 3 years prior to this where we actually had operating expenses running slightly higher on a percentage basis than our revenue growth. So even though revenue growth absolutely was more on a percentage basis, it squeezed our margins. But we started to have a reversion back to more of a mean again. Some of this could be a little bit seasonal. We had lower turn costs, we had lower repairs as a result, not as much turnover. But overall, we had operating expenses that were controlled. We also finally had a little bit of relief in insurance, and insurance expenses had been really high for a lot of years. But just as importantly, our interest expense growth is moderating, and that is, while it's still increased, both because we have slightly higher borrowings, and we took a lot of capped exposure that burned off, and we actually had some of that interest rate went up, but our absolute rates actually came down in the second quarter, and Eric will talk about that a little bit later. With it, we still have some headwinds, and what those headwinds predominantly are is it's really supply. So if you look to the next slide, we really have just a simple supply headwind that we think it's starting to abate and it's starting to correct. But over the last half dozen to a dozen years, we've had over 350,000 people per year move to North Carolina and South Carolina, and on a net basis, that's more than 100,000 people of growth in the two states. And it's about 90% of the net growth that you see in these states. So relocation is and continues to be a really robust indicator of what's going on for us. And so our whole issue is last year and this year, we had almost 40,000 new net apartments, which outpaced this migration. Historically, somewhere around 15 to 25,000 had been really the absorbable number, but as we've talked about in the past, when low rates hit during the latter part of COVID, a lot of projects got greenlit that might not have otherwise gotten greenlit, and so they moved ahead early. You had with it statewide, you went from almost a 94% occupancy to with Raleigh and Charlotte getting most of the supply as low as 88 and 89%. And that's kind of a 6% adjustment over 3 years, which I don't really recall that ever happening. But what we do see is those new deliveries really start to fall off dramatically in 2026 and 2027. And so where we're seeing that is as we head into the third quarter, we're definitely seeing that a little bit on our asking rents and our occupancy. But what we're also seeing is what we talked about last quarter, and that is we felt really good going into this year that interest rates and cap rates and projections really matched, and so we've been able to actually take advantage of some purchases. So the first half of this year, we bought 7 properties. And we currently have 2 more slated so far in 2025 with the potential for maybe a few more. And we really have very high conviction on this. There has not been a lot of debate internally about can we make this deal work? Oh, can we get to the number, et cetera. And it's in many regards it's we get into transactions, we have regular negotiating power. And by regular, it's, if you see something that doesn't seem to work, there better be something to offset it, or, we'll have to modify the terms. And I would say the buyers and the sellers are really working, much more with kind of a common lens for the first time in a long time. So with it, we have 3 transactions in 3 different markets, 7 communities and 950 units. We spent $138 million up front for those purchases. So call it about 140 to $150,000 per door, depending on the community and the property. But we also have more moderated value add plans. And those value add plans are about $15,000 to $16,000 a door. For those of you who've been with us for a long time, we've certainly done projects with smaller budgets than that. We've done a lot with bigger budgets than that. But we think that these are the right value add plans for what we're seeing in the market right now. These assets generally are well-maintained, good assets that we think are just a little bit under marketed, or potentially a little bit undermanaged because one of the sellers had a lot of leverage associated with it. We're raising a little bit less than 50% equity. We've had really nice experience with a couple different joint venture partners at this point, a new one to us, and then one that came in size. We've done them as 90/10s. And so again, what that does is that provides us with ample upside with kind of returns. We're picking up 15 to 30% of the returns above a preset hurdle of 10% in most cases. And so with it on a portfolio basis, the IRRs are targeted at 17%. And that's kind of right down the fairway for us. Equity multiple of greater than 2 times, and it really just comes to how long do we end up holding this. But also importantly, it really strengthened our position in Charleston and Wilmington, 2 markets that are really seeing tremendous growth and really good wide market dynamics, and it deepens us a little bit in Greensboro. And so with it, we're seeing a lot of opportunities, and so we are starting to think that we need to raise a lot more capital to start to address that. Rana?
Yeah, certainly a good segue to our side of the house. Just want to remind everyone to continue to drop any questions you have on the chat bot below. So yeah, we've had a pretty exciting quarter on the investor relations side. So just want to update everyone on the call about, basically the past few quarters, we've been looking to broaden our distribution across many different channels, of which is the broker dealer and registered investment advisor platforms. This presents basically a multi-trillion dollar industry that will allow us to tap into various financial advisors and private wealth platforms. The first step in that is working with a third-party due diligence platform. For us, that is a group called FactRight. We actually just attended their conference about 2 months ago in Salt Lake City. So a really big opportunity for us. We also continue to do co-branded webinar just to educate our investor base in terms of what else is out there from an alternative investment standpoint. Um, the last one we did, which hopefully brought some value to everyone on the call, was a group called Starbuck Capital in Texas and Forge Trust. So we had about 150 registrants on that call. So if you're not weren't available for that, feel free to check out Ginkgo Best. Also, again, it's on our YouTube channel as well. In terms of accessibility, Ginkgo Notes are also available within your retirement account. So if you do have some idle cash in your retirement account, Alto IRA is a good option for investors who are looking to potentially park money in anywhere from 6 to 7.5% rates at short terms. We were recently featured um, on Advanto IRA this quarter, which is another new channel. And then the last thing I'll highlight here is we've been strengthening a lot of our relationships with our physician community. My colleague and I, Kevin Smythe, recently attended Passive Income MD in Newport Beach a couple weeks ago, and sort of been hearing a common theme where these physicians are increasingly looking for passive income streams that offer tax efficiencies, and a lot of these physicians are looking for financial independence. So this definitely is in line with our investment philosophy. This slide is sort of a jarring one if it's the first time you're looking at it. Certainly not claiming to be an economist, but there are some important data points that are worth surfacing. If you look at nearly or most asset classes these days are sort of hitting all-time highs, whether that's stocks, gold, or crypto. And the these asset classes are not necessarily strengthening in fundamentals, but what is, I think, most jarring is just the dollar has weakened significantly over the last year. In particular, it's down about 11%, and it's having its worst half of the year in 40 years. So yes, against this backdrop, we're just encouraging investors to sort of pick up their heads, revisit their portfolio allocation, and maybe look to potentially prioritize stabilized cash flowing real assets that hold sort of intrinsic value. So with that, and building on that same theme, we're always on the phones with investors, and they always ask sort of, what does a well-balanced portfolio look like? Obviously there are many options for investors to allocate capital, but we feel that we provide two complementary parts of the capital stack here that are backed by Ginkgo's portfolio of real assets. So we are comparing the two types here. We have Ginkgo notes that are short term. The last couple notes we've launched are anywhere from 3 to 6 months. They're fixed income investments. They offer stable returns with short durations. The flip side of that, Ginkgo REITs common shares. These are long-term equity investments, so we're sort of banking on growth potential and monthly income. How they're different is the REIT has the potential for higher returns as real estate appreciates. Notes offer contractually obligated yields with lower volatility. We pay our common share dividends monthly, where the notes they're accrued. So you have the option to get your principal back and your interest at maturity. Both of these investment products offer a 1099 simple tax form. And I think what's really compelling here, up until December 31st, or the end of this year, we've also reduced our minimum, especially as investors are looking to recalibrate their portfolio. So for Ginkgo REITs, our minimum will be $10,000, and it'll be $5,000 for notes. So that promotion will go through December 31st. So we hope that we're offering investors the ability to, smooth volatility, enhance yields, as well as, build their portfolio with two investment products. And, there might be other individual asset syndications through sidecar vehicles that we see towards the end of the year. So with that, I will pass it over to Eric Stamp, who will go through the financials in greater detail.
Yeah, thanks, Rada. Yeah, I'm going to go through earnings, take a look at the balance sheet, all the debt activity that we've kind of gone through late 2024 and through the first half of 2025. And then I'll end it with our NAV update and share price. But from an earnings perspective, Bill alluded to this, it was a very strong first half. A lot of it came from just collections and occupancy and stabilizing our operating expenses, and so a lot of it wasn't just from your traditional rent growth, but more just from kind of going back to the basics of occupancy, focusing on that, collections, and maintaining our operating expenses. And one thing we've kind of been doing over the past year or 6 months, and for those that have read the annual report and semi-annual report, you'll kind of notice that we're transitioning more to reporting on what is actually owned by the REIT. So that's what we consider proportional units owned. So that's the top line item there. The REIT is actually invested in, as of 6/30, was 6,800 units. And after some acquisitions in Q3, it's now over close to 7,500 units. But this is what's directly owned by the REIT and attributable to all of the REIT shareholders. So, can see over the past, 12 months, there hasn't been a ton of activity and acquisition wise. And so all of this growth that we're seeing, this double digit growth, and all of our metrics that we look at, revenue, NOI, and lastly, AFFO, which is the direct earnings per share of each investor's shares, is that this is all pretty organic. And it hasn't been a lot to do with more acquisitions, but more to actual operating improvements over the first 6 months of 2025. And as we kind of move forward, Bill did mention this, we expect some softness in Q3. Some of it is related to collections. Generally in Q3, there's just higher operating expenses as we move into the summer months, repairs, turnover, a little bit more leasing activity leads to a little bit more operating expense increase as well for turnover costs and whatnot. So we do expect some softness going into Q3, but nonetheless, the performance in our first half we're pretty proud of. We're 100% covering our dividend, our cash dividend, which is an exciting improvement over 2024. Moving into the balance sheet here, we could kind of see what we've been doing over the past 6 to 12 months. We've really been focusing on refinancing our variable rate or floating rate loans to fixed rate, which has really been great for consistency in the portfolio. One, it allows us to actually maintain and provide a consistent streamline of cash flow and avoid all the volatility of interest rates and risk and rate caps and hedges that we've had to kind of contemplate over the past 12 months. So really over the past 2024 and 2025, we've really just been focused on how we can make the balance sheet stronger and improve metrics across the board, which we can see over the first half of 2025. We've had some pretty telling improvements over our balance sheet. We've even, with all the refinances going from floating rate to fixed rate, we've been able to decrease our interest rate by over 10 basis points. And that's inclusive of the notes program that Rada was discussing, where we're still paying investors, 6.5% to 7% on those. So that's inclusive of those, but it's just how we've been able to refinance out of these floating rate loans and the volatility that has come with that for the portfolio over the past 2 years has been really improvement to our balance sheet and allowing us to more focus on operations than maintaining the risk of interest rates. Which the next slide we can see here kind of all the activity that we've been doing over the past 6 months. It basically started late 2024 and through the first half of 2025. We're on pace this year to refinance over $220 million of debt on a portfolio of around 600 to 650 million of total debt. So we've been doing a lot of work on our capital markets and debt activity to get out of the floating rate market and fixing our portfolio over the past 8 to 12 months. As a result, we've already had 70% of what the REIT directly owns is now fixed rate, which this is up significantly from a year ago. We were like 44%. So there's been a lot of activity on our capital markets team over the past 12 months. Looking forward, we think we have one or two more large loans to refinance out before we kind of get out of this phase of these 2020 to 2022 transactions where cap rates were significantly lower, almost 200 basis points lower. We had floating rate debt of 2 to 3 years that caused a lot of volatility. So over the next call it 4 to 6 months, we think we're in the final phase of getting out of those loans into fixed rate that are a little bit more longer term, 5 to 10 year holds, and allows us a little bit more consistency in the portfolio. So while there has been some material pay downs required by the REIT, we think this is basically in the last leg of it, and moving forward, we feel well positioned to be out of floating rate and into more of a stable fixed rate market. On the next slide, we can kind of see what we have coming up over the next, short term, 6 to 12 months. And as you can kind of see here, majority of our debt is now going to be delayed past, 2027 and 2028 with, 50% of the portfolio after 2030. So there's been a lot of improvement over the past 6 months. The exciting part is just the opportunity of getting out of these higher interest rate loans where we're paying over 6% and into a market where we've locked in under 5% for 5 to 10 year loans. So even with all that, we've managed to lower our interest rate with all of this activity to under 5%, and we think we'll even be lower as we move into 2026 as we get out of the last remaining large loan in 2025 that we're paying over 6% on. So a lot of opportunity over the next 6 months and maintaining our business model of locking in long-term fixed rate loans that we can achieve and we can cash flow on, and getting out of the floating rate market. And then lastly, I'll talk about NAV. The board did convene a couple or almost 2 months ago. We'll have another board meeting next month. But part of our Q2 into Q3 meeting, they convened and determined based off of our NAV that it should continue at 136 a share. So there's been no movement in 2025. The one thing that kind of offset all of the portfolio gains of revenue, NOI over the past 6 months has just been, we did see an uptick in what our cap rates were, which was a little surprising based off of where we think interest rates are. But our appraiser has continued to kind of increase cap rates over the past 6 months, then higher than we expected and higher than we're seeing in actual transactions being marked at. So we still think there's a lag between what the appraisers cap rates are and what we're actually seeing transacted, and what we've actually seen transacted in our own transactions over the past 6 months. So we expect rates or cap rates to come down. That is just a timing of when that might happen. But with that said, a 10 basis points increase in cap rates was truly offset by just our cash flow gains over the past 6 to 12 months. So with that, those kind of two offset, and the share price at 136 was maintained. Same with the dividend, same dividend as we've had. We do think we're actually in a good place with our dividend coverage. It's fully covered by our earnings in the first half of 2025. So our dividend is maintained at 5.6% annually, which from our tax equivalent standpoint, that's almost 9%. Based off of everything for the REIT dividend being classified as return of capital, which is basically just deferring any taxes on dividends for the past 6 years. So no investor in the REIT has paid tax on any of our dividends since been incepted. And then our look at our outlook for the next 6 to 12 months, we think there's a lot of opportunity still. The REIT has a large hybrid play or a GP position where they are the sponsor, or they receive the promote in the underlying joint venture deals, which allow for a lot of potential upside. If we look at a swing of 25 basis points being down versus up, it's not proportional. There's a lot more upside. If interest rate or cap rates came down 25 basis points, we could see a 20 plus dollar swing in our NAV, which on the flip side, if cap rates increase 10%, there's only limited movement of $8 to $10 share decrease. So there's a lot more upside than we see downside at this point, because we have the promote play, which allows us to see significant performance gains if interest rates kind of compress a little bit and cap rates come down. And then lastly, we continue to see better dividends, especially as we have done all the refinance and capital markets activity over the past 6 months. It's allowed for more of a stable cash flow for us, which supports the monthly dividend that we pay, and future performance that we see. So overall, I think there's a lot of large potential over the next 6 to 12 months, and that we're excited about. Not only coming from the acquisition growth that we've done and acquisition activity that we're in, but the potential for upside if cap rates come down just slightly, there could be a material increase in our NAV and the underlying NAV per share. So a lot of positive outlook that we see on our side that we're excited about. So with that, I'll pass it back to you, Rada.
Okay, great. Thanks, Eric. So yeah, as sort of the questions start to come in, just want to highlight one of the things that Eric mentioned. So would encourage everyone to go to Ginkgo Vest on the Ginkgo REIT offerings page. We do have our mid-year report pinned towards the bottom of the offering memo. It is more robust report that has audited financials. The team spent a lot of time and effort working on that, so would encourage everyone to check it out. Also, welcome feedback. Also, as much as I had compared and contrasted the REIT and notes, just want to highlight a couple key dates. So we do monthly closings for the REIT. Our next closing for the REIT is October 31st, and then we'll have one end of November, and that'll take us to the end of the year. With our notes, our next closing, which we're live on our series number 6, short-term notes, 3-month duration. That closing is November 4th, and if I'm not mistaken, there should be one more note offering on December 19th. So I wanted to flag and highlight those key dates. So I guess with that, as the questions are coming in, just wanted to, looks like there's one here about collections. So collections have improved and occupancy has sort of stabilized around 95%. The question is this sustained? Can we talk a little bit about sort of supply absorption in key markets that we're in?
So just to be clear, it was 95% in the first half, but in the summer with the turnover, we're down into kind of the mid to high 92, 93 area at a lot of assets. We also have a lot of renovation taking place. And so what we can control is closer to 95%, but as we clean up some of our portfolio, we have that. I would say that in general, we think the collection story is going to continue to be good. We think that that we're going to go sideways on occupancy from at least through the early part of the fall and into the winter. Unusually, the last 2 seasons, we've actually made occupancy gains in the wintertime, which is not a historic thing for us. Generally, our occupancy in the North Carolina, South Carolina region tends to peak during the summer months, but we've actually had a little bit of a contrary outcome with that. And so I would wish I could give you an answer why, but I don't really have a good answer other than to say we're looking to create some occupancy gains as we get into the winter months again. We don't have that much the turnover that takes place during those months, so any migration, any movement tends to be a net a net positive for us.
Great. We have someone here sort of patting us on the back in regards to our acquisitions. So 950 units, $138 million of acquisitions. I know it's still early, but how are these sort of performing in line with underwriting? Any hiccups on takeovers?
Eric?
Yeah, so performance, the largest transaction we had was our portfolio in Charleston, which was close to 700 units. That came online late in August, so we're actually just closing the first month of September, and we'll have those closed shortly. So there hasn't been a lot of material changes since we took over, but the exciting part is that in that case, that portfolio, the transition team was almost of the former owner to now, almost 20 team members came over from the seller. So we've had a lot of consistency, understanding, how they do things, which has allowed us to kind of help them adopt our policies and procedures. But it's exciting that the same team or the majority of the same team was able to stay in place from takeover to today. So for the near term, we expect to just kind of operate, with what we had for the model, which is a lot of capital improvements. But for the past month, it's just been kind of understanding how the team does business and working with them to take the transition to Ginkgo's takeover. So there hasn't been a lot of changes in the past month, but we expect a lot of activity to happen over the next 12 months as we have a pretty significant capital plan there, which will help grow and be part of what we expect performance to be.
Yeah, I recently sat in on some of these takeover meetings, and I'm really impressed with the level of detail that goes on in the organization that Sarah, head of asset management. So I can speak firsthand about just the coordination. Um, Another question here. We've refinanced $200 million year to date and have another $60 million planned on the debt side. I mean, obviously, no one has a crystal ball, but curious as to what the outlook looks like for capital markets with these refinancings.
Like
Yeah, I'll
market is
take.
what the market is what it is.
Yeah,
It's
yeah. Go ahead, Bill.
right. Everything works at these levels. If somebody needs 4% rates to make their portfolio work, and then their portfolio is not marked properly at this point. So for us, from a value accretion perspective, we'll put on all the fixed rate financing we can right now because it's accretive, and that's that took a few years for that to happen. But basically, where the market's marked and where we can finance, it's slightly accretive, and in most cases, within 1 year, all fixed rate financing appears to be accretive for us at this point.
Yeah, and I'll just add to that. Over the past 24 to 36 months, the volatility that we've had in the portfolio from having this floating rate debt to having to purchase and acquire hedges for interest rate caps and whatnot have been so significant that we're paying a much higher load than even the interest rate is stated, because these lenders and agencies required you to escrow monthly for the replacement caps at what the future interest rate forward curve looked like. So it was very expensive. There's cases on these assets where really with the load of the escrows plus the debt service, we're paying 7 to 8%. So to be able to refinance out and get a rate of 5 or maybe even slightly below 5 is absolutely accretive to the portfolio and something that we can maintain. Um, that will drive cash flow for the portfolio and just provide a significant more amount of stability for us.
Great. So I'm just seeing one more question here, and it's pointing to one of the slides that I had. The US dollar is at multi-decade lows, implying that purchasing power has been reduced. How is Ginkgo positioned for sort of potential rise in construction costs? Are we doing anything preventatively? What's our outlook there?
We're not doing anything proactively. Realistically, our portfolio is worth, in today's market, call it $1.1 billion to $1.2 billion. I'm not sure with kind of what we added and what we might also be selling right now. Let's call it $1.1 billion. We
Mhm.
don't expect that our recurring CapEx and our non-recurring CapEx is going to be much more than probably $20 to $30 million this year. And so on a value basis, relative to our portfolio, I'm sort of a mixed mind on it. When we're talking about that chart and its inclusion, definitely for a lot of the near-term supply chain issues, there's going to be pressure for appliances, things of that nature, which is a lot of where we do spend our money. But in the long run, you have this whole replacement cost issue in our existing assets. If all components have inflation, again, your replacement cost is going up at the same time where we've already got a fixed cost on, call it 97% of the value of our portfolio, excluding the 2 to 3% that we reinvest every year. So, you know, I can see a situation, not unlike what happened during COVID, where you had, a fueled inflation that occurred with very low interest rates. In this case, where you actually have really high inflation on just expense loads caused by a weak dollar. I can actually see the same thing. Long term, I do see a lot more onshoring, and the onshoring aspect of that is really good for the Carolinas. It's really good for South Carolina. South Carolina's been a huge onshore beneficiary, but uh, I would love to tell everybody we plan for this. We don't plan for inflation. We just don't.
Great. So not seeing any more questions, but before I turn it to Bill and Eric for any parting thoughts, just want to highlight here that, feel free to check out ginkgovest.com. Obviously, we host any new investment opportunities. There's a wealth of information in regards to webinars, blogs, educational series. So I encourage everyone to take a look at that. Obviously, everyone on the investor relations team is available to answer any questions. So our contact information is on this slide here. But I guess with that, I'll just pass it back to the rest of the team if there's any other thoughts or words.
No, thank you for your time.
Now, the only thing
Thank you,
I have
everyone.
is to check out our semi-annual report. Was released last week or the week before. We love feedback on that. Again, we have definitely transitioned our reporting to outside of what you'll see on the GAAP financials to more of what we think is representative of the total portfolio of what you're actually invested in. And we think our reporting has been improved quite a bit. But again, we'd love feedback on the report, and so we can make changes accordingly as we move forward. But definitely check it out.
Thank you, everyone.
Thanks.